Chapter 1: The Path to Becoming a Licensed Advisor. The decision to pursue a career in the Canadian insurance industry is more than just a professional pivot. It is an entry into a cornerstone of the national economy. As a licensed advisor, you represent the bridge between complex financial products and the families who rely on them for security and peace of mind. The modern insurance landscape is no longer defined by simple door-to-door sales. Today, it is a sophisticated field of wealth management, estate planning, and risk mitigation, offering a career path that balances significant earning potential with the profound satisfaction of helping clients navigate their most vulnerable moments. To step into this role, you must first navigate the Life License Qualification Program, more commonly known as the LLQP. This program is the national standard designed to ensure that every individual entering the field possesses a rigorous understanding of life insurance, accident and sickness coverage, segregated funds, and the ethical legalities that govern the industry. It is a demanding curriculum that acts as a gatekeeper, protecting the public interest by ensuring that only those with a comprehensive grasp of financial mechanics and consumer protection laws can carry the title of a licensed agent. The journey ahead is structured into 4 primary pillars: life insurance, ethics and professional practice, segregated funds and annuities, and accident and sickness insurance. Mastering these topics requires more than just rote memorization. It demands an ability to apply theoretical concepts to real-world scenarios. Whether you are helping a young couple protect their first mortgage or advising a business owner on succession planning, the knowledge you gain through the LLQP will serve as the foundation of your professional integrity. While the volume of information can feel overwhelming at the outset, the path is well-defined. By obtaining your license, you unlock a diverse array of opportunities, from working within established agencies and financial institutions to building your own independent practice. This book is designed to strip away the complexity of the provincial exams, providing you with a clear roadmap to transition from a student of the industry to a trusted advisor. Your journey toward professional independence starts here, with a commitment to mastering the mechanics of the LLQP. Chapter 2: The Foundations of Life Insurance. At its core, life insurance is not merely a financial product. It is a sophisticated mechanism for managing the inherent uncertainty of the human condition. Every day, we navigate a landscape of risk, the possibility of loss that looms over our financial stability and the well-being of those we love. While we cannot predict the timing of the inevitable, life insurance allows for the systematic transfer of that risk from an individual to a collective pool. This foundational concept of risk sharing ensures that the catastrophic financial burden of a single death is distributed across thousands of policyholders, transforming an unpredictable personal tragedy into a manageable societal certainty. To understand the mechanics of this transfer, one must first grasp the principle of mortality, the bedrock upon which every policy is built. Actuaries use vast data sets to determine mortality rates, the statistical probability of death within a specific age group. This is the law of large numbers in action. While it is impossible to know when one specific person will pass away, it is remarkably easy to predict how many people in a group of 100,000 will die in a given year. By harnessing these mathematical truths, insurance companies can calculate the precise premiums required to ensure that when a claim is eventually made, the funds are not only available, but guaranteed. Crucial to this arrangement is the legal framework that distinguishes insurance from a mere wager. For a life insurance contract to be valid, there must exist an insurable interest at the time of application. This means the policy owner must stand to suffer a genuine financial loss or emotional hardship upon the death of the insured. This principle, alongside the doctrine of utmost good faith, forms the ethical spine of the industry. It requires both the applicant and the insurer to act with total transparency, ensuring that the promise of protection is built on a foundation of honesty and mutual benefit. Ultimately, the foundations of life insurance are laid in the balance between rigorous mathematics and social responsibility. As you move through this study guide, remember that every complex universal life policy or simple term contract is governed by these same elemental rules. By mastering the concepts of risk pooling, mortality statistics, and legal capacity, you are not just learning how to sell a product, you are learning how the modern world provides a safety net for the unexpected, turning professional expertise into profound peace of mind for your future clients. Chapter 3. Term Insurance. Protection for a set time. At its core, term insurance is the most transparent expression of life insurance. Pure protection. Unlike permanent policies that bundle insurance with a savings component, term insurance acts as a financial safety net designed to catch a family or business during their most vulnerable years. It is defined by its simplicity, providing a predetermined death benefit if the insured passes away within a specific time frame. For many clients, this is the just-in-case solution that offers the highest amount of coverage for the lowest initial premium, making it an indispensable tool for young families managing mortgages, childcare costs, and the early stages of debt. The versatility of term insurance lies in its duration-specific mechanics, such as renewable and convertible provisions. A renewable term policy allows the policyholder to extend their coverage at the end of the initial period without having to provide new evidence of insurability. This is a critical safeguard for clients whose health may have declined, ensuring they aren't left unprotected when they need it most. Meanwhile, the conversion feature acts as a bridge to long-term financial planning, granting the insured the right to swap their temporary term policy for a permanent one. Understanding these contractual rights is essential for any advisor, as they provide the flexibility to adapt a client's coverage as their financial goals evolve from debt protection to estate planning. Beyond standard-level terms, specialized products like decreasing term insurance offer targeted solutions for specific financial obligations. Often used in conjunction with a mortgage, the death benefit of a decreasing term policy gradually reduces over time, mirroring the declining balance of a major debt. This ensures the client isn't paying for more coverage than they need as their liabilities shrink. As you master these various structures, your role as an advisor shifts from salesperson to strategist. Success in the LLQP exam and in the field requires you to recognize the precise moment a client's needs transition from temporary risk management to permanent security, and how to use term insurance as the foundation for that journey. Chapter 4. Permanent Insurance. Building Long-Term Security. While term insurance acts as a temporary safety net, permanent insurance is designed to be a cornerstone of a lifelong financial architecture. It is the transition from if to when, providing a guaranteed death benefit regardless of how long the policyholder lives. Unlike the fixed duration of term policies, permanent insurance integrates protection with a savings component, transforming a simple risk management tool into a sophisticated asset class. For the LLQP candidate, the challenge lies in understanding how these policies manage to sustain level premiums over a lifetime by overfunding the early years to offset the inevitable high costs of old age. Whole life insurance serves as the traditional model of this permanence, characterized by its set-it-and-forget-it reliability. Within this category, the distinction between participating and non-participating policies is a vital concept for the provincial exam. A non-participating policy offers certainty with fixed premiums and death benefits, but a participating policy invites the consumer into the insurer's success. Through policy dividends, which are essentially a return of a portion of the premium, policyholders can increase their coverage or reduce their out-of-pocket costs, allowing the policy to grow in tandem with their financial needs. The true engine of permanent insurance, however, is the cash surrender value, CSV. As premiums are paid into a whole life or universal life policy, a portion is reserved and invested by the insurer, gradually accumulating as equity within the contract. This isn't just a ledger entry. It represents a liquid resource that the policyholder can access through loans or withdrawals. Understanding the mechanics of the CSV, how it is calculated, how it is taxed upon surrender, and how it differs from the policy's face value is essential to mastering the complexities of the life insurance landscape. Universal life insurance introduces a layer of transparency and flexibility that traditional whole life often lacks. By unbundling the three core components of the policy, mortality costs, administration expenses, and the investment account, Universal life allows the policyholder to adjust their premiums and death benefits as their life circumstances evolve. It functions much like a combination of a term insurance policy and a tax-advantaged investment account. For the student, grasping the interplay between these shifting variables is the key to advising clients who seek both death benefit protection and a vehicle for wealth accumulation. Chapter 5. Understanding Universal Life: Flexibility and Growth. Universal Life, UL, insurance is often described as the Swiss Army knife of the financial world, offering a level of customization that traditional whole-life policies simply cannot match. At its core, a UL policy is a clever hybrid. It combines the protection of permanent life insurance with a tax-advantaged investment component. Unlike the rigid premium schedules of other permanent plans, Universal Life is built on a foundation of transparency and unbundling. This means the policyholder can see exactly how much of their premium is going toward the cost of insurance, how much is covering administrative fees, and how much is being funneled into the investment account to grow over time. The true hallmark of the UL contract is its remarkable flexibility regarding premium payments and death benefits. In a world where financial circumstances can shift overnight, UL allows policyholders to adjust their outlays, sometimes skipping payments entirely if the cash value is sufficient to cover the internal costs, or increasing contributions to maximize tax-sheltered growth. When it comes to the payout, students must distinguish between level death benefit options and those that include the account value, level plus account value. Understanding this choice is critical, as it determines whether the policy functions primarily as an affordable safety net or a robust vehicle for wealth accumulation and estate planning. Beneath the surface of this flexibility lies the engine that drives the policy: the cost of insurance, COI. For the LLQP exam, mastering the two primary COI structures, yearly renewable term, YRT, and level cost of insurance, LCOI, is non-negotiable. YRT offers lower initial costs that rise as the insured ages, while LCOI provides predictability with a consistent fee throughout the life of the contract. Grasping how these charges interact with the policy's investment performance is the key to advising clients on the long-term sustainability of their coverage. Finally, the investment account within a universal life policy represents a frontier of opportunity and risk. Depending on the contract, a policyholder might choose from a menu of options ranging from guaranteed interest accounts to those linked to equity market indices. This side fund allows for tax-deferred growth, making it a powerful tool for those who have already maximized their RRSPs and TFSAs. As you dive into the mechanics of these accounts, remember that the goal of the UL specialist is to balance the need for lifelong protection with the client's appetite for market exposure, ensuring the policy remains a pillar of their financial security for decades to come. Chapter 6: Policy Provisions and Riders. Customizing coverage. A life insurance policy is rarely a one-size-fits-all garment. Rather, it is a bespoke contract tailored to the unique risks and financial goals of the policyholder. While the face amount and the premium are the most visible elements, the true mechanics of the contract lie within its provisions and riders. These clauses define the boundaries of the agreement, outlining the rights of the owner, the obligations of the insurer, and the specific circumstances under which a claim will be paid. Navigating these legalities is essential for any advisor, as these terms determine exactly how a policy will perform when it is needed most. At the core of every contract are standard provisions designed to protect both the consumer and the insurance company. Key pillars, such as the incontestability clause, serve as a statute of limitations on the insurer's right to challenge a claim based on applicant misrepresentation, providing the policyholder with ultimate peace of mind after the initial 2-year window. Similarly, the suicide clause acts as a safeguard against adverse selection, balancing the company's risk with the compassionate need to eventually provide coverage for families in even the most tragic circumstances. Understanding these foundational rules is the first step in ensuring that no client is left vulnerable to an unexpected denial of benefits. Beyond these standard protections, riders offer the opportunity to go from basic coverage to comprehensive risk management. These add-ons allow a policyholder to customize their protection without the need for a separate policy. For example, a waiver of premium rider acts as a critical safety net, maintaining a client's coverage if they become totally disabled and unable to work. Meanwhile, the accidental death benefit, often colloquially known as double indemnity, provides an additional payout if tragedy strikes in the form of an accident. These riders are the tools of the trade for an effective advisor, allowing you to bridge the gaps between a client's current reality and their future security. Mastering these provisions and riders is not just about passing an exam, it is about advocacy. By the end of this chapter, you will be able to dissect a life insurance contract with precision, identifying which clauses protect the insurer and which riders provide the most value to the insured. You will learn to view the policy not just as a static document, but as a dynamic financial instrument that can be adjusted to meet the shifting tides of a client's life. Let's begin by breaking down the mandatory provisions that form the legal skeleton of every life insurance policy in Canada. Chapter 7: Beneficiaries and Policy Ownership. In the complex landscape of life insurance, the policy is more than just a contract. It is a legal instrument designed to bridge the gap between a present commitment and a future necessity. At the heart of this instrument lies the delicate interplay between three distinct roles: the life insured, the policy owner, and the beneficiary. While the life insured is the individual whose mortality triggers the claim, they are often the person with the least legal control over the contract itself. It is the policy owner who holds the bundle of rights, possessing the sole authority to surrender the policy, take out loans against its cash value, and perhaps most critically, determine who will ultimately receive the death benefit. For a student of the LLQP, mastering these distinctions is not merely about terminology, it is about localizing the seat of power within the contract. The act of naming a beneficiary is where legal clarity meets personal intent, and the distinction between a revocable and an irrevocable designation is one of the most significant hurdles in insurance law. A revocable beneficiary exists in a state of professional uncertainty. They have an expectancy of the proceeds, but no vested right. The policy owner can strip them of this status at any time for any reason, without their knowledge or consent. However, the moment a beneficiary is named irrevocable, the power dynamic shifts dramatically. The policy owner essentially enters into a legal partnership with the beneficiary. From that point forward, the owner cannot change the designation, assign the policy as collateral, or even access the cash value without the written consent of the irrevocable beneficiary. In the eyes of the law, the beneficiary's right has transformed from a mere hope into a protected property interest. Understanding the mechanics of these changes is essential for avoiding the litigation that often haunts improperly managed estates. When a policy owner decides to update a beneficiary, the declaration must be clear, written, and filed with the insurer to ensure it is binding. Yet, we must also consider the statutory heir, or the unique protections under the Quebec Civil Code, where designations in favor of a spouse are often presumed to be irrevocable unless stated otherwise. As you navigate Chapter 7, look beyond the definitions. Instead, view each designation through the lens of control. Who holds the pen, who must sign the forms, and whose rights are protected when the time comes to fulfill the promise of the policy. Chapter 8: Underwriting: How Risk is Assessed. Underwriting is the silent engine of the insurance industry, the meticulous process where abstract risks are transformed into concrete policy terms. At its core, underwriting is a balancing act of data and probability. When a client submits an application, the insurance company isn't just looking at a name on a page. They are attempting to forecast the future based on a tapestry of health history, lifestyle choices, and statistical trends. The objective is simple but vital: to ensure that the premium charged is perfectly aligned with the level of risk the company is assuming. Without this rigorous vetting process, the financial stability of the insurer and its ability to pay out future claims would be fundamentally compromised. The journey of an application often begins with a deep dive into the applicant's physical reality, frequently facilitated by a medical examiner. This professional serves as the eyes and ears of the insurance carrier, collecting vital signs, blood samples, and medical histories that confirm or expand upon the information provided in the initial paperwork. Beyond the physical exam, underwriters tap into powerful diagnostic tools like the Medical Information Bureau, MIB. Think of the MIB as a secure, shared library of medical codes that prevents non-disclosure or application shopping. By cross-referencing these records, underwriters can identify inconsistencies and ensure that no significant health event remains hidden in the shadows of a neglected file. Once the data is gathered, the underwriter must categorize the applicant into a specific risk class. While many will fall into the standard or preferred categories, some files reveal complexities that require a more nuanced approach, resulting in rated policies. A rating is not a rejection. Rather, it is a customized adjustment, often in the form of a higher premium or specific exclusions that reflects an above-average risk. For the advisor, understanding these distinctions is crucial for managing client expectations. Navigating the underwriting phase requires patience and precision, as it is the final gate through which a promise of financial security must pass before it becomes a legal reality. Chapter 9: The Tax Treatment of Life Insurance. Understanding the tax treatment of life insurance is the bridge between being a simple salesperson and becoming a sophisticated financial advisor. To the uninitiated, life insurance is often viewed solely through the lens of a death benefit. However, for the taxpayer, a life insurance policy is a complex financial instrument governed by the Income Tax Act. The core of this chapter lies in mastering the delicate interplay between policy growth and government regulation, ensuring that the promise of financial security isn't eroded by avoidable tax liabilities. At the heart of policy taxation is the Adjusted Cost Base, ACB. Think of the ACB as the tax-paid portion of the policy, the baseline used to determine which distributions are considered a return of capital and which are deemed taxable income. Calculating the ACB is a dynamic process. It fluctuates as premiums are paid and the net cost of pure insurance, NCPI, is deducted. In the eyes of the Canada Revenue Agency, any disposition of the policy, whether through a partial withdrawal, a surrender, or a policy loan, that exceeds this ACB threshold triggers a policy gain, which is taxed as straightforward income rather than at the more favorable capital gains rate. For corporate clients, the stakes are even higher, centering on the power of the Capital Dividend Account, CDA. The CDA is a virtual account that tracks non-taxable surpluses, most notably the proceeds of a life insurance policy. When a corporation receives a death benefit, the amount in excess of the policy's ACB is credited to the CDA. This allows the corporation to pay out tax-free dividends to its shareholders, a strategy that represents one of the most significant tax planning advantages in the Canadian financial landscape. Mastering these mechanics is not just about passing an exam, it is about providing the roadmap for wealth preservation across generations. Chapter 10: Disability Insurance: Protecting Human Capital. In the complex world of financial planning, we often spend a disproportionate amount of time discussing the accumulation of wealth and the protection of physical assets, homes, cars, and investment portfolios. Yet, for the vast majority of Canadians, the most valuable asset they will ever own is not found in a bank statement or a property deed. It is their human capital. This is the inherent ability to wake up each morning, go to work, and trade specialized skills for an income. When an illness or injury strikes, this engine of wealth grinds to a halt, creating a financial void that most savings accounts are ill-equipped to fill. Disability insurance acts as the primary safeguard for this human capital, ensuring that a physical setback does not evolve into a lifelong financial catastrophe. To master this segment of the LLQP, you must first grasp the nuances of how disability is defined within a legal contract, as these definitions determine when the benefit checks start flowing. The industry standard hinges on the distinction between own occupation and any occupation coverage. An own occupation rider is the gold standard, providing benefits if the insured cannot perform the specific duties of their specialized profession, even if they could technically work in a different field. In contrast, any occupation is a more restrictive threshold, requiring the insured to be unable to perform any job for which they are suited by education, training, or experience. Understanding the bridge between these definitions and how they often shift after a 2-year period is essential for accurately advising clients on their level of risk. Calculating the appropriate amount of coverage is a delicate balancing act that requires a deep dive into a client's net income and existing obligations. Unlike life insurance, where the goal is often to provide a massive lump sum, disability insurance is designed to replace a percentage of earned income, typically 60% to 85%, to maintain the client's standard of living without creating a moral hazard where being on claim is more profitable than working. As you study this chapter, focus on the integration of various income sources, including the Canada Pension Plan, CPP, disability benefits, and workers' compensation. Your role is to build a laddered defense that protects the client's most precious resource, their future earning potential. Chapter 11, Critical Illness and Long-Term Care Insurance. The modern financial landscape is often focused on building wealth, yet many Canadians overlook the primary threat to their balance sheets: a sudden, catastrophic shift in health. While life insurance prepares for the end of a journey, critical illness, CI insurance, is designed for the survival of the struggle. It is a living benefit that provides a tax-free lump sum payment upon the diagnosis of a covered condition, such as cancer, stroke, or heart attack, provided the policyholder survives the initial waiting period. Unlike disability insurance, which replaces lost income, CI insurance acts as a financial shield, allowing the insured to focus entirely on recovery without the crushing weight of mortgage payments, experimental treatment costs, or the need to liquidate retirement savings. Understanding the mechanics of a critical illness policy requires a deep dive into payout triggers. For a claim to be successful, the diagnosis must meet the precise contractual definition outlined in the policy. It isn't enough to simply be unwell. The condition must align with the benchmark of severity defined by the insurer, and the client must survive the survival period, typically 30 days. This chapter will break down these specific definitions and explore how different policy structures, ranging from basic coverage for 4 conditions to comprehensive plans covering over 24, can be tailored to a client's unique risk profile and family medical history. Parallel to the immediate shock of a critical illness is the slow, steady progression of aging or chronic infirmity, which is where long-term care (LTC) insurance becomes an essential pillar of a sound financial plan. LTC insurance is designed to address the lost independence factor. It triggers when a policyholder can no longer perform a specific number of activities of daily living, ADLs, such as bathing, dressing, or eating, or when they experience significant cognitive impairment. Whether the care is administered in a private home or a skilled nursing facility, the objective is the same: to preserve the individual's dignity and the family's inheritance. Eligibility and underwriting for these products are rigorous, as the insurer is essentially taking on the risk of the client's future health trajectory. As you study for the LLQP, pay close attention to the distinctions between these two products. While CI insurance focuses on the diagnosis of a specific disease, LTC insurance focuses on the resulting loss of functional capacity. Mastering these nuances allows an advisor to move beyond simply selling a policy and toward building a comprehensive safety net that protects a client's lifestyle and longevity. Chapter 12, Accident and Sickness Supplemental Health Coverage. The Canadian healthcare landscape is often defined by a paradox of pride and pragmatism. While every citizen takes comfort in the safety net of the provincial healthcare system, a closer look reveals that this universal coverage is far from comprehensive. The reality is that the public system is designed to keep you alive and stable, but it is the supplemental health insurance market that ensures you can afford to recover. As an advisor, your role is to bridge the gap between what the government provides at the hospital bedside and the significant out-of-pocket expenses, from prescription drugs to physiotherapists, that wait for the patient at home. Extended Healthcare, EHC, serves as the primary instrument for filling these voids. While provincial plans cover physician visits and wardroom stays, EHC plans act as a financial buffer against the escalating costs of specialized care. medical appliances, and vision health. Understanding the mechanics of these plans involves more than just memorizing a list of benefits. It requires a deep dive into the architecture of deductibles, co-insurance, and benefit caps. These elements determine how much of the financial burden is shifted back to the policyholder and ultimately how effective the plan is in protecting the client's lifestyle during a medical crisis. Central to this chapter is the distinction between group coverage and individual plans. For many Canadians, supplemental insurance is a silent passenger on their employment contract, offering the convenience of lower premiums and guaranteed issue regardless of medical history. However, the portability of these benefits, or lack thereof, presents a strategic challenge. When a client leaves a job or retires, they move from the safety of a collective pool into the rigorous world of individual underwriting, where age and pre-existing conditions dictate their eligibility. Mastering the nuances of follow-me plans and conversion privileges is essential for ensuring your clients don't lose their protection during life's inevitable transitions. Finally, we must address the specialized world of dental insurance. Unlike general health care, dental coverage is largely excluded from public funding, making it a cornerstone of supplemental planning. From basic preventative cleanings to complex restorative work like bridges and crowns, dental plans operate on a ladder of reimbursement levels. By the end of this chapter, you will be able to categorize these services and explain to your clients how a well-structured plan does more than just fix a tooth. It preserves their capital by turning unpredictable, high-cost dental emergencies into manageable monthly premiums. Chapter 13, An Introduction to Segregated Funds. To the casual observer, segregated funds may look indistinguishable from mutual funds. Both pool investor capital to access a diversified portfolio of stocks, bonds, or other securities, and both offer the benefit of professional management. However, beneath the surface of a segregated fund lies a powerful structural difference. It is not merely an investment, but a specialized individual variable insurance contract. This legal framework serves as a protective wrapper, granting the investor unique safeguards that are simply unavailable in the traditional world of mutual funds. The defining characteristic of a segregated fund, and the primary reason it is a cornerstone of the LLQP, is the presence of capital guarantees. Unlike a standard investment where you are fully exposed to the whims of the market, a segregated fund provides a safety net. These guarantees typically apply in two specific scenarios: maturity and death. By law, a segregated fund must guarantee at least 75% of the capital invested, though many products on the market offer a more robust 100% guarantee. This means that even if the underlying market crashes, the contract holder or their beneficiary is protected from catastrophic loss, provided the holding period or the life of the insured is met. Understanding the mechanics of these guarantees requires a shift in perspective from growth to preservation. The maturity guarantee ensures that after a set period, usually 10 years, the contract holder will receive either the current market value of their investment or the guaranteed percentage of their original principal, whichever is higher. Similarly, the death benefit guarantee acts as a shield for the estate. If the annuitant passes away while the markets are down, the designated beneficiary is still entitled to the guaranteed amount. This dual-layered protection transforms the investment into a tool for estate planning, offering peace of mind to those who want the upside of equity markets with a contractual floor to catch them if they fall. Crucially, the segregated funds refers to the fact that these assets are kept separate from the general insurance funds of the life insurance company. Because these are insurance products, they offer advantages that go beyond simple price protection, including the potential for creditor protection and the ability to bypass the costly and public probate process. As you master this chapter, keep in mind that you are not just studying a type of investment. You are learning about a sophisticated hybrid that marries the growth potential of the stock market with the contractual certainties of life insurance. Chapter 14: Legal Advantages of Segregated Funds and Annuities. While many investors focus primarily on market returns and risk management, the true hallmark of a sophisticated financial plan lies in how effectively it shields wealth from external threats. Segregated funds and annuities offer a unique legal fortress that traditional mutual funds simply cannot match. At the heart of this protection is the concept of creditor protection, a feature rooted in provincial insurance legislation. When a policyholder designates a family member within the restricted class, such as a spouse, child, or parent, as a beneficiary, the assets within the contract are generally shielded from the claims of creditors. This creates a powerful safety net for business owners and professionals whose personal assets might otherwise be vulnerable to the unpredictable tides of litigation or bankruptcy. Beyond the immediate security of creditor protection, segregated funds serve as an essential tool for efficient estate planning by bypassing the often cumbersome probate process. In Canada, when an individual passes away, assets held in a traditional investment account typically fall into the estate, where they are subject to provincial probate fees and potential delays that can last months or even years. However, because segregated funds are structured as insurance contracts, the death benefit flows directly to the named beneficiaries. This private transfer of wealth ensures that liquidity is available to loved ones almost immediately, circumventing the public record and keeping the family's financial affairs confidential. The strategic integration of these legal advantages allows for a seamless transition of legacy that is both cost-effective and secure. By avoiding probate, a client not only saves on the direct percentage-based taxes levied by the province, but also eliminates many of the legal and administrative costs associated with settling an estate. Ultimately, mastering the LLQP requires a deep appreciation for these statutory benefits. A segregated fund is not just a collection of market-linked assets, but a legally protected vehicle designed to preserve wealth against the two most significant eroders of an estate: legal claims and government bureaucracy. Chapter 15, Annuities, Creating Guaranteed Income for Life. At its core, an annuity is a financial promise, a contract between an investor and an insurance company designed to mitigate the greatest risk of the modern age, outliving one's money. While life insurance is built to manage the risk of dying too soon, annuities are built to manage the risk of living too long. By converting a lump sum of capital into a predictable, steady stream of income, annuities transform the uncertainty of market fluctuations and longevity into a structured guarantee. To master this section of the LLQP, you must think of an annuity not as a singular product, but as a two-phase journey that shifts from building a reservoir to opening the floodgates. The first phase, known as the accumulation period, is where the foundation is laid. During this stage, the contract owner deposits funds that grow on a tax-deferred basis, allowing the principal to benefit from compound interest or market gains without the immediate erosion of annual taxation. However, the true mechanics of the annuity come alive during the payout phase. This is the moment of annuitization, where the accumulated capital is surrendered to the insurer in exchange for a series of periodic payments. Understanding the transition between these two phases is critical for the exam, as it dictates the tax treatment, the liquidity of the funds, and the nature of the legal obligations held by the insurer. The most common structure you will encounter is the life annuity, a product that guarantees payments for as long as the annuitant draws breath. This serves as a personal pension, where the insurance company assumes the longevity risk. In contrast, a term certain annuity provides payments for a fixed period, say 10 or 20 years, independent of how long the individual lives. If the annuitant passes away before the term ends, the remaining payments are directed to a beneficiary. Distinguishing between these two is vital, as the life annuity offers the highest level of protection against outliving your assets, while the term certain provides a guaranteed total payout amount. Finally, navigating the tax implications of these contracts is where many students find themselves challenged. The taxation of an annuity is fundamentally tied to the source of the funds used to purchase it. Registered annuities, funded by vehicles like an RRSP or RIF, are taxed in their entirety because the original contributions were made with pre-tax dollars. Non-registered annuities, however, are treated more like a return of capital. Only the interest portion of the payment is taxable, while the principal is returned tax-free. Mastering these distinctions is not just about passing a test. It is about understanding how to craft a tax-efficient retirement strategy that ensures your clients never have to face a day without a paycheck. Chapter 16: Registered Retirement Savings and Investment Vehicles. Provincial Rules. Navigating the landscape of Canadian registered savings accounts is akin to choosing the right vessel for a long voyage, while the destination of financial security remains the same. The mechanics of each vehicle determine how much cargo you can carry and how much of it the government will claim at the various ports of call. For the life insurance professional, understanding the nuances of registered retirement savings plans, RRSPs, tax-free savings accounts, TFSAs, and registered disability savings plans, RDSPs, is not merely an academic exercise. It is the foundation of holistic financial planning. These accounts are the structural frameworks within which clients build their futures, and your ability to distinguish between tax-deferred growth and tax-free withdrawals will define the value you bring to the table. The true versatility of the LLQP professional lies in the bridge between traditional banking products and insurance-based investments. Segregated funds and certain annuity products can be held within these registered vehicles, offering a unique layer of protection that standard mutual funds cannot match. By housing an insurance product within an RRSP or a RRIF, a client gains the dual advantage of government-sanctioned tax incentives and the private security of death benefits and creditor protection. This chapter focuses on the mechanics of these wrappers, exploring how contribution room is calculated, the consequences of overcontribution, and the critical timelines for converting accumulation vehicles into income streams. While federal legislation sets the broad strokes for registered accounts, the provincial overlay adds a layer of complexity that every advisor must master. From the specific age requirements for opening accounts to the localized rules governing the designation of beneficiaries, provincial jurisdiction can significantly alter a client's estate planning strategy. We will delve into the transition from the Registered Education Savings Plan, RESP, to post-secondary funding and the mandatory conversion of RRSPs into Registered Retirement Income Funds. By the end of the year, the client turns 71. Mastering these rules ensures that you are not just selling a product, but managing a life cycle of wealth that respects both the law and the client's long-term objectives. Chapter 17: Ethics and Professional Practice. The Advisor's Code. In the life insurance industry, your reputation is your most valuable asset, far outweighing the size of your book of business or the impressive nature of your commission statements. Ethics in this field is not a static list of thou shalt nots, but a proactive commitment to a professional code that places the client at the center of every decision. At its heart lies the principle of utmost good faith, a bilateral trust where you assume the dual role of a protector of the client's interests and a gatekeeper for the insurer's integrity. Mastering the LLQP requires more than just memorizing policy features. It demands an internalized understanding of the high standard of conduct expected of those who hold the keys to a family's financial security. The cornerstone of this ethical framework is the Know Your Client, KYC rule. This is not a mere administrative hurdle or a box to be checked on a digital application. It is the fundamental process of discovery that ensures every recommendation is suitable. To truly know your client, you must look beyond their age and income to understand their risk tolerance, their long-term aspirations, and the specific vulnerabilities they face. A recommendation made in a vacuum, without a deep dive into the client's unique circumstances, is not just poor service, it is a professional failure. Every product you suggest must be a tailored solution to a documented need, standing up to the scrutiny of both regulators and your own conscience. Beyond the technicalities of suitability lies the concept of holding out, which dictates how you present yourself to the public. Transparency is paramount. You must be crystal clear about the scope of your license, the companies you represent, and the nature of the compensation you receive. Misrepresentation, whether through silence or exaggeration, erodes the public's trust in the financial services sector. By maintaining professional boundaries and avoiding conflicts of interest, or disclosing them fully when they are unavoidable, You ensure that the client's interest remains the singular priority. In this chapter, we will explore the nuances of these responsibilities, providing you with a reliable compass to navigate the complex moral landscape of the insurance profession. Chapter 18: The Regulatory Environment and Compliance. Navigating the world of life insurance is about more than just understanding policy provisions and actuarial tables. It is about operating within a sophisticated ecosystem of oversight designed to protect the public interest. In Canada, this oversight is not centralized under a single federal banner, but is instead a collaborative tapestry of provincial mandates and national standards. As a prospective agent, you are entering a profession where compliance is not merely a box to check, but the very foundation of your license. Your ability to operate depends on your fluency in the rules set forth by the provincial bodies that govern your specific jurisdiction, such as the Financial Services Regulatory Authority of Ontario, FSRA, or the Autorité des Marchés Financiers, AMF, in Quebec. At the heart of this regulatory framework are two pivotal national organizations that harmonize the industry standards: the Canadian Council of Insurance Regulators, CCIR, and the Canadian Insurance Services Regulatory Organizations, CSRO. While the actual power to license agents remains with the provinces, these bodies provide the blueprint for consistency across the country. The CCIR focuses on the strategic side, ensuring that insurance products are sold fairly and that companies remain solvent, while CSRO concentrates on the boots on the ground, the qualifications and professional conduct of the individual brokers and agents. Together, they ensure that regardless of whether you are sitting in a boardroom in Toronto or a home office in Halifax, the ethical expectations remain uniform. Compliance is often viewed through the lens of restriction, but in the context of the LLQP, it is better understood as a shield for both the client and the practitioner. The principles of fair treatment of customers, FTC, serve as the North Star for all regulatory directives. This means that regulators are not just looking for technical accuracy in your paperwork. They are looking for evidence of suitability and a commitment to transparency. Every provincial statute and every national guideline is built upon the same fundamental premise: that the information asymmetry between an expert agent and a layperson must never be exploited. As you prepare for this section of the exam, focus on the interplay between these organizations and the legal weight of their mandates. You will need to distinguish between the bodies that establish best practices and the provincial authorities that have the power to levy fines or revoke your license. Understanding this hierarchy is more than an academic exercise. It is your roadmap for a career defined by integrity. In a field built entirely on the promise of future security, the regulatory environment is the mechanism that ensures those promises are kept. Chapter 19: Legal Aspects of Insurance Contracts. The foundation of every insurance policy is not merely a promise of financial protection, but a binding legal document governed by strict statutory requirements. In Canada, the strength of these agreements rests upon the Provincial Insurance Acts, which dictate how a contract is born and how it must be interpreted. For a student of the LLQP, understanding these legalities is the difference between simply selling a product and facilitating a legitimate transfer of risk. To the layperson, insurance may seem like a complex maze of fine print, but to the professional, it is a structured architecture built upon four non-negotiable pillars: offer and acceptance, consideration, legal capacity, and legality of purpose. The journey of an insurance contract begins with the dynamic between offer and acceptance. This is not as simple as a handshake. It is a formal progression where the applicant typically makes the offer by submitting a completed application along with the initial premium. The insurer then reviews the risk through the lens of underwriting and provides acceptance by issuing the policy. However, if the insurer modifies the terms, perhaps by adding an exclusion or changing the rating, the original offer is technically rejected, and a counteroffer is put on the table. The contract only gains its legal life once there is a true meeting of the minds, where both parties agree to the exact same terms without ambiguity. Beyond the agreement itself, a contract must involve consideration, which serves as the fuel that makes the legal engine run. In the insurance world, consideration is a two-way street. The applicant provides the premium and the statements made in the application, while the insurer provides the promise to pay out a valid claim in the future. Without this exchange of value, the contract is essentially an empty promise and holds no weight in a court of law. It is the tangible commitment from both sides that elevates a casual conversation into a high-stakes legal obligation. Finally, for the contract to be enforceable, the parties involved must possess the legal capacity to enter into the agreement. This means the applicant must be of sound mind and meet the minimum age requirements specified by provincial law. Furthermore, the contract must have a legal object, meaning its purpose cannot violate public policy or involve criminal activity. You cannot, for instance, take out an insurance policy on a business used for illegal purposes. By ensuring that every contract meets these rigorous standards of capacity and legality, the Provincial Insurance Acts protect not only the insurer and the insured, but the integrity of the entire financial services industry. Chapter 20. The Life Insurance Sales Process and Documentation. The life insurance sales process is far more than a simple transaction. It is a structured, ethical journey designed to transition a client from uncertainty to security. Professionalism begins long before a policy is ever issued, rooting itself in the very first interaction. As a licensed agent, your role is to act as a fiduciary guide, ensuring that every step, from the initial introduction to the final signature, is anchored in transparency and regulatory compliance. This process is not merely a checklist to satisfy provincial regulators, but a framework for building a relationship of trust that can last for decades. The foundation of this relationship is the initial disclosure, a non-negotiable step where you define your professional identity. Before discussing the nuances of term or permanent insurance, you must clearly outline your qualifications, the companies you represent, and how you are compensated. This transparency eliminates potential conflicts of interest and sets a professional tone for the fact-finding mission ahead. By documenting this disclosure, you protect both the client's interests and your own professional integrity, ensuring that the client understands exactly who is providing the advice they are about to receive. Once the groundwork is laid, the focus shifts to the needs analysis, the diagnostic heart of the sales process. This stage requires a meticulous evaluation of the client's financial landscape, including their liabilities, income replacement needs, and long-term estate goals. A compliant needs analysis moves beyond guesswork, using hard data to justify the specific coverage amounts recommended. Documentation is critical here. If a recommendation is not supported by a written analysis of the client's circumstances, it fails the test of professional conduct. You are not just selling a product, you are prescribing a financial solution tailored to a unique human story. The process culminates in the application and the eventual delivery of the policy, but the duty of care does not end when the contract is signed. Accurate documentation of the reason why letter, a summary explaining why the specific product was chosen, is the final pillar of a compliant file. When you deliver the policy, you must ensure the client understands the cooling-off period, the exclusions, and the ongoing obligations of the contract. By mastering these sequential steps, you transform a complex legal process into a seamless, professional experience that centers on the client's peace of mind. Chapter 21. Needs Analysis. Calculating the right coverage. Determining the right amount of life insurance is rarely a matter of guesswork. It is a disciplined exercise in financial foresight. As an advisor, your task is to translate a client's abstract anxieties into a concrete mathematical reality. This process, known as the needs analysis, serves as the cornerstone of your professional recommendation. It is the bridge between a client's current financial standing and the legacy they wish to secure for their survivors. By meticulously quantifying every potential obligation, from the immediate sting of final expenses to the long-term void of lost income, you transform a vague product into a tailored safety net. The capital needs approach is the industry standard for a reason. It accounts for the immediate liquidity required at the time of death while addressing the ongoing lifestyle needs of the family. We begin by tallying immediate cash needs, which include funeral costs, legal fees, and the settling of outstanding short-term debts. However, the calculation quickly expands to encompass larger liabilities, such as mortgage balances and future education funds. Without a precise accounting of these figures, a policy may provide a false sense of security, leaving a family underfunded at the very moment they are most vulnerable. Beyond the immediate clearance of debt lies the more complex challenge of income replacement. Here, you must assist the client in projecting how much monthly capital their survivors will need to maintain their standard of living once the primary earner's paycheck disappears. This calculation must account for inflation, the duration the income is required, and any existing government benefits, such as the CPP survivor's pension. By subtracting the client's current assets and existing coverage from this total financial requirement, you arrive at the capital gap, a definitive number that represents the exact amount of new insurance required to make the client's family whole. To master this skill, you must move comfortably between the roles of an investigator and a mathematician. In the following exercises, you will be presented with diverse client profiles, ranging from young families with significant mortgage debt to business owners concerned with tax liabilities at death. Your goal is to apply the formulas we have discussed to arrive at a coverage recommendation that is neither so low it leaves the family at risk, nor so high it becomes an unsustainable premium burden. Practical mastery of these calculations is not only essential for passing the LLQP exam, but is the most vital service you will provide to your future clients. Chapter 22: Insurance as an Estate Planning Tool. The cornerstone of a successful estate plan is not merely the accumulation of wealth, but the strategic preservation of it. For many Canadians, the realization of a lifetime of hard work can be met with a significant hurdle upon death: the deemed disposition of assets. When the Canada Revenue Agency treats your capital property as if it were sold at fair market value on the day you pass away, the resulting tax bill on capital gains can be staggering. Without proper liquidity, heirs may be forced into the heartbreaking position of selling off family cottages, liquidating business interests, or dismantling investment portfolios just to satisfy the taxman. This is where life insurance shifts from a simple safety net to a sophisticated financial instrument, providing the immediate tax-free liquidity necessary to keep an estate intact. By utilizing permanent life insurance policies, an estate planner can effectively fund the future tax liability for pennies on the dollar. Since the death benefit is paid out tax-free to named beneficiaries, it serves as a dedicated pool of capital that arrives precisely when it is needed most. This strategy essentially creates a firewall around the estate's other assets. Instead of the estate being eroded by terminal taxes or probate fees, the insurance payout covers these obligations, ensuring that the intended legacy passes to the next generation in its entirety. It is the ultimate tool for tax minimization, transforming a looming debt into a managed and predictable cost. Beyond simple tax coverage, insurance plays a pivotal role in achieving estate equalization, a concept vital for families with non-liquid assets like a private corporation or a family farm. If a business owner intends to leave the company to the child who helped build it, they may lack the liquid cash to provide an equivalent inheritance to their other children. Life insurance bridges this gap, providing a cash benefit to the non-active heirs, while the business remains whole for the successor. In this context, insurance is more than just a financial product. It is a mechanism for fairness and family harmony, ensuring that a legacy is defined by what remains, rather than what was lost to taxes or internal conflict. Chapter 23: Group Benefits. Coverage for the workforce. In the modern corporate landscape, the strength of an organization is often measured not just by its balance sheet, but by the security it provides to its people. Group benefits represent a fundamental shift from individual underwriting to collective risk sharing, offering a safety net that protects the workforce while serving as a critical tool for talent retention. For the advisor, mastering this chapter means moving beyond the needs of a single client and learning to navigate the diverse requirements of an entire employee base. It is here that the concepts of master contracts and certificates of insurance take center stage, defining a legal structure where the employer acts as the policyholder and the employees receive the protection they need without the rigors of individual medical exams. The architecture of group life and health insurance is built upon the principle of administrative efficiency. Unlike individual policies, which are tailored to a person's specific health history, group benefits rely on the law of large numbers to spread risk across an entire population. This allows for the provision of life insurance, usually calculated as a multiple of annual earnings, and extended health benefits that cover everything from prescription drugs to paramedical services. However, this convenience comes with strict eligibility rules, such as the actively at work requirement and the waiting period, designed to prevent adverse selection and ensure that the plan remains financially stable for both the insurer and the plan sponsor. Perhaps the most critical area for any LLQP candidate to grasp is the intersection of group benefits and the taxman. The Canada Revenue Agency, CRA, views these benefits through a specific lens. What constitutes a taxable benefit to the employee, and what can the employer deduct as a business expense? While health and dental premiums paid by the employer are generally non-taxable to the employee outside of Quebec, employer-paid life insurance premiums are added to the worker's income as a taxable benefit. Navigating these nuances is essential for providing accurate advice, as the tax treatment of premiums and disability benefits can significantly alter the actual take-home value of the coverage provided to the workforce. Chapter 24, Exam Strategy, Mastering the Multiple Choice Format. The LLQP exams are not merely a test of what you know. They are a test of how you think under pressure. The multiple choice format is a unique psychological battlefield where the distractors, those cunningly crafted incorrect options, are designed to look just attractive enough to derail a student who is rushing. To master this format, you must approach every question with the mindset of a forensic investigator. This means reading the entire stem of the question twice and identifying the pivot words, terms like except, always, primary, or not, which can invert the entire meaning of a sentence. Before you even glance at the provided answers, try to formulate the solution in your mind. This prevents your brain from being seduced by a plausible-sounding but technically incorrect option. Time management is the silent gatekeeper of exam success. With 4 distinct modules to conquer, you cannot afford to get bogged down in a cyclical struggle with a single complex calculation or a dense paragraph on segregated fund guarantees. Implementing a staged pass strategy is essential. Move through the exam quickly during your first pass, answering only the questions you are 100% certain of. This builds psychological momentum and ensures you bank the easy marks early. For the more challenging items, flag them and return later. Often, a detail found in a later question will act as a cognitive spark, providing the clarity you need to solve a problem that stumped you 20 minutes prior. Beyond the mechanics of the exam room, your study techniques must mirror the modular nature of the curriculum. For the life insurance and accident and sickness modules, focus on the why behind the regulations, as these questions often test application rather than rote memorization. Conversely, when tackling segregated funds and ethics, precision is your greatest ally. Create a mistake log during your practice exams to track not just what you got wrong, but why you got it wrong. Did you misread the question? Did you fall for a distractor? By identifying your personal patterns of error, you transform your study sessions from passive reading into a tactical rehearsal for the real event. Chapter 25, From Student to Professional, Launching Your Career. The transition from candidate to professional is often described as a leap of faith, but in the world of life insurance, it is more akin to a calculated migration. Passing the LLQP exams is a monumental achievement that proves your technical proficiency. However, the license hanging on your wall is not a finish line. It is a starting block. Your first 90 days will be a whirlwind of administrative setup and intensive learning as you move from the theoretical safety of a textbook to the nuanced reality of a kitchen table conversation. This is the period where you must bridge the gap between knowing the definitions of a collateral assignment and explaining to a grieving widow or a young father how these financial instruments provide the security their families deserve. One of the most critical decisions you will make in this nascent stage is choosing a managing general agency, MGA, that aligns with your professional values and growth trajectory. This partnership is the foundation upon which you will build your practice. You aren't just looking for a competitive commission grid. You are looking for a culture of mentorship, robust compliance support, and a diverse shelf of products that allow you to truly act in your client's best interests. A strong MGA will help you navigate the steep learning curve of provincial regulations and the rigorous requirements of continuing education credits, ensuring that your knowledge doesn't stagnate the moment the exam results are posted. As you step into this new role, remember that the most successful advisors are those who never stop being students. The financial landscape is a living organism, shifting with every new tax law, economic fluctuation, and product innovation. Maintaining your license requires a commitment to lifelong learning, but serving your clients requires a commitment to empathy. In your first 90 days, focus on building trust rather than just closing sales. By viewing every interaction as an opportunity to educate and protect, you transform your career from a mere job into a calling. You have mastered the material. Now it is time to master the art of service.